Today, crypto developer Peter Todd pushes back on a documentary that claims he's Satoshi Nakamoto. Marathon Digital looks to capture natural gas to power its mining facilities. And Wyatt Lonergan of VanEck explains the investment firm's new crypto-focused venture fund. At noon Eastern, the largest cryptocurrency by market cap was flat for the past 24 hours, while Ether gained 1.7% and XRP rose nearly 2%, as another firm, Canary Capital, proposed an XRP ETF in a filing with the SEC. Okay, let's talk about the top stories. Developer Peter Todd is denying claims that he is Satoshi Nakamoto. In an HBO documentary released Tuesday titled Money Electric: The Bitcoin Mystery, filmmaker Cullen Hoback claims Todd is the anonymous author behind the Bitcoin white paper. Todd denies the film's claim, calling it nonsense in a post on X. Todd also alleges it was done to drum up media attention. Others in the industry have shared skepticism about the claim as well. Muneeb Ali, CEO of Trust Machines and the creator of Bitcoin Layer 2 stacks, said on X that Peter Todd is not Satoshi, and that anyone who has seriously worked in the Bitcoin industry knows this. Cullen, meanwhile, is staying firm on the claim, resharing posts he believes adds to his case of Todd being Satoshi. Next, Mara Holdings is making moves to generate power for its data centers. The company is partnering with natural gas company Engon to build a 25-megawatt mining operation across Texas and North Dakota. Those sites would be powered off excess natural gas from energy producers with oil fields nearby. CEO Fred Thiel said this would be Mara's first owned power generation assets and that utilizing existing natural gas production would reduce operating costs. Miners have been looking for ways to cut operating costs and boost profits since the Bitcoin halving cut mining rewards in half earlier this year. Last, New Yorker writer Charles Duhigg joined Squawk Box this morning to discuss the wave of tech influence in this election cycle, and he points to the crypto industry being especially key in shaping the 2024 race.
Almost half of every dollar given by a corporation to a super PAC in this election was given by the crypto industry. And they have a very, very specific reason why. They want crypto to be legalized. And they're using that money as a tool to bully politicians. And it's very effective.
Duhigg points to Fair Shake, a crypto super PAC donating to candidates across the U.S. as particularly powerful, even swaying the outcome for a Senate seat in California.
Katie Porter, who was running for the Senate here in California, essentially her race was blown up in the primary because a group named Fair Shake, which is a crypto super PAC, came in and spent $10 million overnight running ads, just annihilating her. And it worked. Politicians in other places saw this happen and they began voting for pro-crypto bills. They began agreeing with and releasing pro-crypto statements. Money matters more than ever before in today's elections, and the people with the most money is the tech industry.
All right, let's talk about VC funding for crypto for our main story. VanEck announced this morning that it's launching a $30 million venture fund focused on startups hoping to revolutionize fintech with crypto and AI. Crypto World's Jordan Smith spoke to Wyatt Lonergan, general partner for VanEck Ventures, about what kinds of startups the fund is targeting.
All right, so you're launching VanEck Ventures. This early stage fund is focused on fintech, crypto, and AI. And I'm curious why those three areas of focus. And for the purposes of Crypto World specifically, why does crypto fit into that strategy?
Yeah, thanks for having me on, Jordan. Very excited to tell you more about VanEck Ventures. Yeah, I mean, we see ourselves as a fintech fund first and foremost at the intersection of crypto and AI. Crypto is really the value layer, and stablecoins to us are very core to that thesis. AI is where you can take financial services that are typically represented by people and now turn those into software. So we're kind of assuming that a lot of the underlying technology here, whether it be the L1 blockchains or the large language models, have been commoditized to a point where now middleware and applications can leverage these primitives really to redesign and create kind of a net new internet native financial system.
Let's keep talking about your areas of interest for just a second. I mean, I feel like most places have really targeted tokenization as the thing that they think will get real buy-in from Wall Street or the larger ecosystem. And tokenization has these cycles of hype, and I think we're somewhere in another hype cycle right now. Is this time different? And what do you see as the types of innovation most likely to succeed in this area that you might be interested in?
Yeah, I mean, I think this hype cycle might be different, right? This is the first time where you're seeing large institutions like BlackRock, like VanEck. Just the other day, Visa announced a stablecoin tokenization platform for banks to create stablecoins and launching that with BBVA. Similarly, I think a lot of that is driven by the fact that the technology has been battle tested, right? Stablecoins are going to settle over $24 trillion this year. All-time supply sits at around, or current supply sits around all-time highs at $170 billion. So it's hard to ignore this, especially when you look at the innovation that stablecoins create. Right now, you can take dollars, upload them onto Coinbase, send them anywhere in the world at the speed of a text message for free. And then that user can take that stablecoin from their wallet and deposit it directly to the bank account. So I think Wall Street and large institutions look at this and say, this is the future, especially when you consider the existing legacy rails. And most of fintech are just very thin layers that sit on top of legacy banking or financial system. Stablecoins take all those middlemen that charge excessive fees, that create slow settlement times, and replace them with software. And so I think you're going to see a lot of institutions start to leverage this. And tokenization for us really just builds upon the formation that stablecoins have already enabled. And now you can create net new assets and markets that were previously illiquid or hard to access. So I think it's going to create a Cambrian explosion of new fintech products over the next decade.
To go back to this announcement, you mentioned that you're looking to spend across 25 to 35 investments ranging between $500,000 and $1 million. And I should note that those are relatively small check sizes in the world of VC funding. So talk to me about your strategy and the kinds of companies you're targeting, or why you think you can compete in this world of inflated valuations or funding rounds, especially in AI, which is getting all the attention right now.
Yeah, I mean, the fund size was very intentional. We want to build a franchise of funds across VanEck, both in the liquid space and in the venture capital space. And I think, frankly, it's not the right time to launch a multi-billion-dollar fund. Venture capital as a whole, I think it's never been harder to be a VC fund. Returns are compressing. It's incredibly competitive. And for most funds, there's no secondary liquidity. So companies are having to stay private longer. And when they do go public, their valuations are getting crushed. So crypto, I think, is actually one of the few areas of venture capital that offers true asymmetric upside. And then having a small fund and having a concentrated portfolio allows us to be really focused on returns. VanEck manages roughly $110 billion. That is an asset management business. This is an investment business, and it's very different. So we want to be small. We want to be focused. We want to be partnering with the best founders at the earliest stage. And to your point on AI, yeah, I think a lot of things are getting bid up, but we're seeing that the underlying technology continues to get commoditized. Inference costs have dropped 85% in like 14 months. It's the fastest technology to get commoditized. But I still think there's a huge opportunity on the B2B SaaS side. We've made a few investments there. And so I wouldn't write off the category, but for us, it's really about getting in early, getting the right ownership, and partnering with the right people.
I want to go back to something you said just there, which was the IPO market and the traditional off-ramps for some of these VCs and the funding that they put in. I mean, we haven't really seen any movement for IPOs from crypto companies. It seems like the debut of crypto companies on US exchanges is pretty murky. What's your take on the proper off-ramp for VCs buying into crypto? And do you think the outlook for IPOs in the crypto industry is going to get better anytime soon?
I think it'll get better. I think stablecoin regulation, we have the Loomis-Gillibrand Payment Stablecoin Act that's currently sitting with Congress that was introduced last April. Good chance that we could see that approved in the lame duck period. If not, I think we all feel pretty confident in the next 12 months. So that will enable, I think, more crypto fintech companies, the likes of Circle, who I used to work for, to be able to go public and be first movers in this market. But I think the other problem here is that we've had a really harsh regulatory environment in crypto that has largely targeted companies releasing tokens. But tokens are a really interesting instrument. They can represent things like the underlying ownership of the network, governance rights, cash flows, or sometimes passive yield through staking. And the structure of these tokens is that the project or company will go public much earlier in their life cycle, usually in the first 2 to 3 years. And so that provides earlier liquidity, better price discovery. In some cases, that hasn't worked out, where you've seen intense volatility tied to the overall crypto asset class. But I think it's awesome. It reminds me a lot of, in the early days of the internet, when companies like Microsoft used to go public at lower valuations, and retail investors could benefit in the upside of that, versus what we're seeing in the traditional venture world, where there's an oversupply of VC capital, and the IPO markets are kind of getting tired of these ridiculous prices that they're coming out with.
Okay, that's all for Crypto World today. We'll be back again tomorrow, and we'll see you then.